Factor income versus factor cost. Listen the story that you'll never forget concept. The village of Ardhagram. One day, a businessman named Ravi wanted to build a flour mill. He needed four things: land, labor, capital, machines, and money. Entrepreneurship, his own management. The village elder told him, "These four are called factors of production because they help produce goods." After 1 month, the flour mill produced wheat flour and earned money. Now Ravi had to pay everyone. He paid landowner rent, workers' wages, bank lender interest, himself, entrepreneur, profit. The elder smiled and said, "These payments are called factor income." Why? Because they are income earned by the owners of the factors of production. Factor income received: land, rent, labor, wages, capital, interest, entrepreneur, profit. So, factor income is equal to income received by the owners of land, labor, capital, and entrepreneurship. Then Arjun asked, "Grandfather, what is factor cost?" The elder took Ravi's account book. He showed wages is equal to 40,000 rupees, rent is equal to 10,000 rupees, interest is equal to 5,000 rupees, profit is equal to 15,000 rupees, total is equal to 70,000 rupees. The elder said, "For the workers and landowner, this 70,000 rupees is factor income. But for Ravi, who is producing flour, the same 70,000 rupees is the cost of hiring these factors." So the same payment has two different names depending on whose side you see it from. Think of it like buying a house. You pay 15,000 rupee rent every month. For you, 15,000 rupees is a cost. For the house owner, 15,000 rupees is income. The money is the same, only the perspective changes. Exactly the same idea applies here. Another example: a factory pays workers 50 lakh rupees as wages. Workers say, "This is our income." Economists call it factor income. Factory owner says, "This is my production cost." Economists call it factor cost. Same money, different viewpoint. Crystal clear difference. Factor income, factor cost. Income received by factor owners. Cost incurred by producer for hiring factors. Receiver's viewpoint. Producer's viewpoint. Rent, wages, interest, profit received. Rent, wages, interest, profit paid. Income concept, cost concept. The golden rule. The elder finally told Arjun, whenever money moves from the producer to the owners of land, labor, capital, and entrepreneurship, it is called factor cost for the producer and factor income for the receiver. Arjun smiled. So they are like two sides of the same coin. The elder replied, "Exactly. The payment never changes, only the viewpoint changes." UPSC memory line. Factor income is the reward earned by the owners of factors of production, whereas factor cost is the expenditure incurred by producers to hire those factors. They represent the same payment viewed from two different perspectives.